You have been investing, your SIPs are running fine, but when you check your portfolio, it doesn't feel like it has grown enough. It's not bad really, but it is not satisfying either. If that's how you feel, this video is for you. Because in most cases, it's not the market, it may not be the fund that you have chosen, but probably it is the way in which the investments are structured. This video is not for people who are not investing. This is for people who are already doing the right thing, that is, those who started investing, but may not be getting the full benefit of compounding. So, in this video, let's discuss 10 reasons why your systematic investments could be stuck. Let's begin. Point number one, no clear outcomes. So, most SIPs start with simple thought, let me start investing. But investing without a goal is like traveling without a destination. You keep moving, but you don't know if you are getting closer or further. For example, if you invest 10,000 per month for 10 years, expecting good returns, you might reach to about 23 to 25 lakh, assuming a return of 12%. But if you have an actual goal which needs about 40 lakh, let's say for example for a child's education or for a down payment of a home, you are not underperforming, you are actually underplanned. We cannot really plan based on percentage return of a fund, but we also cannot expect magic because compounding takes money plus time. What really happened here is SIPs didn't fail, but the planning did. So, how do we fix this? Is every SIP should answer these questions for you. That is, what is this money for and when do I need it? Because clarity improves decisions, and regular reviewing of portfolio, rebalancing, and reinvesting will not give you surprises after 10 years. Moving to second point, it is having too many funds. I often see people investing in 8 to 10 funds or sometimes even 20 funds. If this is you, then you may feel you have diversified your investments. But I would like to ask you to please check if you are just repeating the same funds in different wrappers. So your return starts looking like an index, but without the simplicity of an index. What I mean is, most large cap mutual funds benchmark against Nifty index, which itself has delivered about 11 to 13% compounded annual growth rate over a long period of time. If you hold 8 to 10 funds, many overlap heavily with the same large cap stocks, then the end result will be the same. You unknowingly have similar funds with different AMCs following the same index returns, but with higher complexity and costs. So, large cap funds are a good start, but investing in different funds from different AMCs does not mean you have diversified your portfolio. So, how do we fix this? First thing is reduce to fewer funds and well chosen funds that will make your life simple. If you are investing for long term, let's say in equity mutual funds, you need to make sure you are fine with volatility associated with equity. Instead of choosing many large cap funds, try to see if you can select better funds with different strategies like mid cap funds or flexi cap funds. Again, based on your time horizon and risk appetite. Another important point is you don't have to invest in every newly launched fund. Allow it some time, understand the theme, and then, based on your goals and risk, start small and then gradually increase over time. You should make decisions in such a way you will not withdraw your investments every second year. Every fund you choose should have its own clear role to play in your investment journey. Point number three is changing funds frequently. This is one of the biggest and silent mistakes. You invest in a fund, it underperforms for a year, you switch to a better performing one, and the cycle repeats. What's happening here? You're always entering after performance and exiting before recovery. The market cycles are confusing you. For example, data shows equity SIPs return over 10 to 15% on an average over a long period of time, but only if investors stay invested through the market cycles. Investors who stopped investing during, let's say, 2008 crash or 2020 COVID crash missed the strongest recovery phase. Many did not even restart the SIP they stopped. Missing even a few recovery months can significantly reduce long term returns. The fact is, exiting an investment is very easy, but when you think of restarting your SIPs, your mind keeps questioning the recent memory of market correction, and you keep thinking the moment I invest, the market will go down. Timing the market is not a wise thing to do in many cases. It only leads to confusion and finally people give up on it. How to fix this is evaluate funds over a full market cycle, not in a very short term. Take a long period and check how your funds have performed in spite of all the volatility. In case you are a busy professional or someone who does not want to spend a lot of time in financial decisions or analysis, then it's important to simplify things for you. A small suggestion here is if you think you don't understand these things, it's wise to invest some time to learn things first. This knowledge about finance and decision making will serve you for a lifetime. Point 4, wrong fund with wrong time horizon. Let's say your goal is 3 years away, but your SIP is in a volatile equity fund. You are thinking and taking unnecessary risk. And if your goal is 15 years later, but you are playing it too safe, then you are going to lose the growth part of this investment. For example, debt funds historically deliver about 6 to 8% return on an average, while equity funds deliver an average return of 10 to 12% over a long period. So, if you invest long term money in debt, you lose growth because debt instruments are expected to provide stable return with low volatility, mostly focusing on capital protection. If you invest for short term in equity, you are going to face the risk of volatility because equity is risky, which we know, as compared to debt. But in a long term, equity gives better return than other asset classes, mostly focusing on wealth creation. So, over 10 to 15 years, this mismatch can cost lakhs in missed compounding, and most people think these things don't work. So, how do we fix this confusion? First thing is match your investments to your timeline and financial goals. Time horizon decides your strategy of investment. Make your decisions not just based on percentage return, but a holistic view on why you are investing, how long are you staying invested, and when do you want this money back. This gives you clarity and it allows you to take time, and when you have longer time period you will be ready to take risk which is needed in places like equity for wealth creation. Point 5, no asset allocation. So some portfolios are fully based on equity investments, some are randomly mixed up. Some are just because my friend said so, but very few are intentionally designed. Without asset allocation, your portfolio has no balance, which means too much risk or too much volatility or too little growth. We spoke about this point in the previous point, but here the perspective is very different. During market crash of 2008 or 2020, equity portfolios fell sharply in a very short period. But investors with balanced allocation between different asset classes like equity, debt, gold, and other areas experienced lower drawdowns. They stayed invested longer without fear and benefited more, especially when markets started to recover. So, asset allocation improves our behavior as well, which improves return over a long period of time. Because you're not focused on return alone, you are having patience to wait, and you're not forced to act on fear and withdraw your investments. How do we fix this? Is decide your asset mix based on your risk and goal. Don't go by tips. Stick to your decision knowing why you invested this allocation. You see, investing also involves knowing yourself. So you should also keep your age in mind while allocating funds based on asset classes. So asset allocation done well is part of risk management for your portfolio. Going to point 6, SIP is not increasing over time. What does this mean? Your income or your earning capacity increases over time, but your SIP stays the same. So, this is one of the missed opportunities which you will realize after decades because compounding works best when you feed it more over time gradually. For example, let's take scenarios. Let's say you have invested 10,000 every month in SIP for 20 years at a return of 12%. On the other hand, you have increased the SIP by just over 10% year on year as your earning capacity increased or as your salary increased if you are a working professional. So, just by increasing your SIP with a small percentage year on year, your net value of your investment will increase without your knowledge. So, in this example, a 10,000 SIP simply invested as an SIP would have amounted to a total value of 92 lakh over 20 years at 12%. Whereas if you had increased your investments by just about 10% every year, your net value of investments would be 1 crore 86 lakh. So that difference, nearly about 1 crore difference, is just because you increased your investments rather than forgetting where you invested. So, how do we look at this? Increase your SIP annually, even if it means a small 5 or 10%, which makes a big difference in a long run. As your earning capacity increases, you need to increase your investments as well. Not all of it, but some part of it. If you have made wise decisions, you don't have to reinvent the strategies of investing. You just have to stay invested consistently and keep investing as your financial situation improves. Moving to point 7, expecting fast results. When you begin investing, in the first few years, the growth feels very slow. And that's where most people get impatient. But compounding doesn't work in straight line. It is slow and then over a period of time it accelerates. There is one more problem here. When people consume a lot of information about certain investments, they see historical returns that are very impressive and they expect that the same thing will repeat as soon as they start investing. Even strong funds have bad years. You must have heard investments are good if you go to flexi cap fund or a blue chip fund. They have delivered about 12 to 14% over a period of time, but there are no promises of 20, 30 or more percent consistently. So expecting fast results would only lead to impatience, frequent switching funds and poor outcomes. This will become a pattern and you will start applying this where it is not necessary, even when there is no need to change your investment strategy. How do we fix this is give your investments time to mature. Early years build the foundation. Start small and gradually increase investments along with your confidence. As you see some improvement, your confidence will improve as well. And as a decision maker, if you are not confident, it eventually shows up in your investment decisions also. Point 8, costs associated with your investment eating into returns. Every investment has a cost associated with it. Even small costs make a lot of difference over a long period of time. We are talking long term here and compounding as well. So, when we start investing, a small cost of 1% difference does not look like a big hole in the pocket. But as the portfolio grows, it does matter a lot. Let's understand this with an example. A monthly SIP of, let's say, 50,000 over 20 years with a return of 12% would give you 4.6 crore, whereas a return of 11% over 20 years would give you 4.07 crore. That's the impact of a 1% difference in your portfolio over a very long period of time. So, how do we deal with this? Be mindful of costs and choose efficient investments where appropriate. This is important, especially while thinking long term. For example, let's say for a retirement plan or for child's education, which cannot be compromised. You don't want to keep changing funds just because of expense ratio or a tax component. So use good judgment and stick to your plan. Not all costs are wrong. So some funds with huge asset under management and great returns also have cost associated with it. So topics like this may need a deeper understanding of the concepts associated with your investments. If you don't want to make such mistakes and realize only after a decade of investment, then you need to spend a little time learning this. If you are interested, please explore our courses to understand better. I would leave the link in the description. Point 9 is not reviewing at all. So, long term investing does not mean ignoring your portfolio. Most people use the phrase called set and forget. Some funds may change strategy, some may consistently underperform. If you never review, you will never notice. So, fund performance depends on various parameters. For example, fund managers' decisions, strategy changes, market conditions. A fund that performs well can also change track and start performing not so well. It loses its edge, or it increases risk, or underperforms the benchmark. Without reviewing, you get stuck in structural underperformance. How do we deal with this then? So, to fix this, we have to review at least once a year. Even if you don't want to change things immediately, you can take time to make decisions rather than realizing after 10 years. Yes, it's true that you should stay invested and not change often, but yearly review is not something you can compromise. It just takes a few minutes to check what's working and what's not working in your portfolio. Don't just sit there blindly, even if your investments are handled by somebody else. Be responsible and accountable for your investment decisions with right reasons. That will reduce confusion and regrets later. Point number 10, lack of conviction. When you don't fully understand your investments, every market fall feels uncomfortable and every new advice feels better than yours. And that leads to stopping SIPs or making emotional financial decisions. Example, investors who continued their SIPs during downturns benefited from buying at lower NAVs, boosting long term returns. Those who stopped SIPs missed accumulating and also delayed compounding. How to fix this is know why you invested first, then the conviction reduces the panic. Conviction and confidence develop over a long period of time. This is why learning how to invest is important when you are deciding your investments or even when someone else is handling it for you. If things get really hard, which can happen sometimes, you can reduce the amount of SIP for a while and get back later instead of completely stopping the investment or withdrawing in fear and never coming back again. If you act on fear, how will you be able to make decisions when you have to reinvest? Let me ask you some most important questions which will help you in decision making. Do you know why each SIP in your portfolio exists? If market falls tomorrow by 20 or 30%, will you continue investing? Do you have a clear plan in mind, or are you just hoping things will work out later? Think about it. Systematic investments or any investment is like any other goal in life. You don't see results in the first few months, but if you stay consistent and follow a simple executable plan, results will show up. You don't need to be the smartest investor with scientific calculators. You just need to be consistent with the right structure that works specially for you. Wealth is not created by chasing the best funds, it is created by staying invested in a well designed system that suits you. So, if this helped you think differently, stay connected. We simplify finance and decisions for you. If you want to learn more in depth about mutual fund investing, do check our courses in the description below. As always, I would love to see your comments. Do take some time to share your thoughts. If you like this video, like, share, and subscribe to my channel. That will encourage me to do more videos and bring you more flavors of investments. Thank you for staying till the end. It was pleasure serving you. See you in the next video.